Welcome to the Pirls Stock Market Commentary video, your weekly window on stock market technical conditions featuring the proprietary bull bear point and figure market breadth summary chart for August 18th, 2019. Market breadth. With this past week's market decline, our bull bear point and figure ratio at 0.53 fell from 0.73 last week. The total count of securities in bullish or bearish patterns increased 2% to 3,047. The count of bearish stocks increased 16%, while the count of stocks in bullish patterns decreased 16%. The Pirls P&F Market Breadth Summary Chart shows us a market now 3 weeks in bearish territory. Paid subscribers have access to the Open Office Calc data from which the chart is generated. You may become a paid subscriber by emailing s2pmarketsignal@protonmail.com for payment and access instructions, or by visiting Patreon. To receive the weekly Pirls Stock Market Commentary via email, free of charge, simply enter your email address in the space provided and click Follow. The well-known market breadth indicator, the Nasdaq McClellan Summation Index, fell 147 points for the fifth decline in 10 weeks. At a negative 353.69 points, it continues below all 8 tops above plus 100 and continues below the February 2018 bottom, has fallen below the July 2017 and May 2019 bottoms, and continues above the remaining 2 bottoms below minus 100 in the last 30 months. Volume analysis. In this week's volume analysis, the Nasdaq Composite Index ended in neither accumulation nor distribution mode, with average daily volume lower than the prior week. In the last 2 weeks, the Nasdaq had 2 accumulation days and 2 distribution days. Accumulation days are counted when the index closes up on higher volume than the prior market day, while distribution days occur when the index closes down on volume higher than the prior market day. Last week, the Nasdaq ended in neither accumulation nor distribution mode, on higher average daily volume. Momentum. The CCI 20 daily, continuing in the Woody's downtrend begun last week, is now at negative 60.01, up from negative 76.41 last week. At Wednesday 8:15 close, it formed a zero-line reject short entry signal within the plus or minus 50 range required, rising later in the week, but not above the zero-line reject pivot. So we stay in the trade and will continue following this trade simulation in next week's commentary. In Woody's CCI trading system, 6 consecutive bars above or below zero are required for a change of trend. The weekly CCI 20 of the Nasdaq Composite Index began a Woody's uptrend 22 weeks ago, while the daily CCI 20 began a Woody's downtrend 1 week ago. The CCI 20 weekly in a Woody's uptrend at negative 25.33 fell from negative 21.23 last week. It continues within the plus or minus 50 range for a valid zero-line reject entry signal if the CCI 20 rises next week. Industry rotation the last 2 weeks. All of the top 5 industries are positive, and all of the bottom 5 are negative. Summary: REITs and some tech on the top. Oil services, KBW Bank, and some tech on the bottom. Bullish: oil services continues in the bottom 5. REITs continues in the top 5. Semis, disk drives, and comp tech have entered the top 5. Gold and silver has left the top 5. Disk drives, semis, and computer hardware have left the bottom 5. Bearish: KBW Bank and networkers have entered the bottom 5. Focus this week from www.investmentwatchblog.com. Quote, confidence must be maintained under all circumstances, or we're heading into a global recession first, and then a U.S. recession to follow. End quote. From northmantrader.com. The following are some key excerpts. Markets are subject to a giant con game, the game of confidence. Confidence must be maintained under all circumstances, or we're heading into a global recession first, and then a U.S. recession to follow. 9 major economies are either in recession or on the verge of it. Once again, the world is looking to central banks to bail everyone out, and for stimulus programs to be launched to rescue a global economy that hasn't been able to do without in 10 years. U.S. consumers are holding the U.S. economy up is the consensus, as they keep spending for now, but already we saw a dip in confidence. Why? Trade tensions, political tensions, and yes, concerns that the longest business cycle may come to an end. Add scary stock market headlines, and before you know it, the consumer is holding back. Markets are subject to a giant con game, the game of confidence. Confidence must be maintained under all circumstances, or we're all heading into a global recession first, and then a U.S. recession to follow. You really think it's an accident we see intervention always at the point of serious trouble? Markets are subject to a giant con game, the game of confidence. Confidence must be maintained under all circumstances, or we're heading into a global recession first, and then a U.S. recession to follow. Always chasing reality, never admitting mistakes. Why? Because confidence must be maintained. If the supposed stewards of the economy don't know what they're doing, why should anyone have confidence in their ability to prevent what the bond market is signaling? Best keep pretending we know what we're doing. No wonder Trump called the big bank CEOs. Don't expect Trump to be beneath agreeing to a shoddy marketing deal, as long as it serves the larger purpose, and therein lies the risk for bears. Get a surprise truce, or even a shoddy deal, and a massive relief rally, spurring confidence back up, can certainly ensue into Q4 and push the global recession another year or two further into the future. And it is absolutely necessary here, as the 2019 uptrend has been broken, and as markets have once again rejected new highs and dropped below previous highs. And here's the problem in all this. When central banks have normalized and have plenty of ammunition, they have efficacy. But they haven't normalized. And when the business cycle turns in earnest, a couple of rate cuts are not enough. For the Fed, the choice is clear. Blow the market valuation wall beyond its historic limits, or risk a massive sell-off by disappointing and ruining confidence. Thank you for watching this week's Sand to Pirls Stock Market Commentary video featuring the proprietary bull bear point and figure market breadth summary chart compiled by Donald Pearl. For Sand to Pirls Stock Market Commentary, I'm Cynthia Pearl, hoping that you have been enjoying a peaceful and pleasant weekend, that you are looking forward to a prosperous and productive week coming up, and wishing you true success.